G'day expats and welcome to another episode of Expat Chat, episode number 77 today. We're climbing the ranks quickly and joined by my colleague, mate, friend, business partner, business coach, mentor, all those titles, Mr. James Ridley, God of the Asia Pacific region. G'day, James.
G'day, Brad. I think if I could control copy and do the exact same, I
Choop.
would. And exactly, mate. And for those dialing in or tuning in on your video channel today, as always, joined with Brett Evans, the managing director for the European, Middle East, and Africa region. Brett, how's the sandpit treating today? Last time we talked, you said it was starting to get a bit fresh, 18 degrees some mornings. That's
No,
pretty good.
we had a bit of rain last night. Yeah, I walked
Ooh.
out. I got 3 drops on me. It was a torrential downpour in our version, but there's a bit of instability going around still, which is nice. And summer's not here yet. We're still hanging on with our fingers to the good weather. It'll change
Mm.
overnight, and then next thing you know, yeah, it'll be hot. So
Yep.
from our point of
Yeah,
view,
well,
we're just pushing on.
yeah, well, I mean, it's what second day of autumn today in Australia, so
Yeah,
we'll start to feel those cool breezes coming through. In sort of late autumn, you get these great southerlies, these sort of the cooler southerlies that come through. They bring the ground swell. God,
remember that?
it's
Yeah, it's
yeah,
nice.
that's it. Yeah, that's it. So these fresh breezes start to come through late autumn and obviously start to lose the light in the day, later in the mornings, later obviously earlier in the evenings. So be interested to see all that taking place. But mate, let's jump into today's episode where we are going to talk about inheritance as a general topic because it got voted on within the Facebook group that we run. So if you're
Link
not in
down
that
below.
group, guys,
Link
that's
down
it.
below.
Expat Financial Forum, jump in there. And we've got a few different topics to talk about, but before we jump into it, I guess we should always do that little disclaimer. I think it's my
No, you're
turn,
new your
isn't it?
job. You're new your job. You've inherited it, so all yours, brother.
Oh, I seemed to be pretty silky smooth last time, but I'm not as confident this time. But anything, or ladies and gentlemen, anything you hear today should not be construed as personal financial advice. Anything you hear today is to be considered as entertainment and information purposes only. If you do need advice, please feel free to reach out. That'll probably do it.
Exactly. And then in legal phrase, yada yada yada. Don't listen to us. Talk to us later.
That's it. We're here to just soothe your ears with our silky smooth voices.
Exactly. And good
Now,
heads for radio.
that's it, mate. Now, jumping in today, I mean, there's a few sort of general topics under inheritance that we want to talk about. I know we'll sort of deep dive a little bit into CGT Event K3, the main residence, investment property, super nominations. When you sort of look at what's going to start happening and what is already happening now, it's this probably the largest wealth transference,
Yeah.
generational wealth transference from baby boomers. Um, Probably for the next sort of 10 to 20 years, I guess you could say. And it means that a lot of younger individuals are going to come into probably a significant amount of wealth in the next 5 to 10 years within Australia. And if we are an expat and you're a non-resident, you've sort of got to work out what the best way to, I suppose, have a bit of a plan and an estate plan around how those assets are going to be carved up,
Mm-hmm.
especially when you're receiving them and you're abroad and what you're doing after that, all those sort of things. So I thought, why not jump into it? I mean, we can start first of all with probably the main residence, inheriting someone's main residence. I mean, one thing that changed back on the 30th of June 2020 was, and a quick refresh, was they removed the main residence exemption for Australian expats or anyone that's deemed to be a non-resident of Australia. Now, it did change a little bit on the main residence exemption when you inherit a property, when you're overseas and abroad, but you're still given a 2-year relief.
Yeah,
So,
exactly. And that's the thing. It's to me, I mean, the death of a family member is always a tragic event and it takes
mm,
time to absorb and it's very simple to put things on the back burner.
mm,
However, unfortunately, the clock starts ticking from the day that they pass away for you
does.
to
Mm,
make financial considerations and decisions.
mm,
And unfortunately, I have met people recently who have tripped over the 2-year line and
yeah.
then they're like, mentally, okay, I'm ready to deal with this now. I'm going to sell this property. And I go, oops, should have talked to you last month
That's it.
because
Yep.
because of that 2-year rule. So, mate, do you want to run through the 2-year rule and how that works for those receiving property or those inheriting property as a non-resident for tax purposes?
Yeah. So, I mean, right now, whether you're an Australian tax resident or a non-resident, and you inherit someone's main residence, typically you're given 2 years. You're given 2 years to make a decision as to whether you sell that property. If you sell it within that 2-year period, well, you're benefiting from their main residence. So you're benefiting from their main residence exemption, sorry. So it means that that would be a tax-free transaction. Sometimes you might choose to rent out that property for maybe a year and then sell it still within that 2 years. Again, that 2 years is sort of this temporary relief rule where it's giving you time to grieve, tie up financial affairs, and off you go. So 2 years is essentially the governing rule right now in terms of when you can sell. Outside of that, if you are an expat or a non-resident inheriting a main residence and you take longer than 2 years, well, that's unfortunately when you'll definitely have to pay some prorated amount of capital gains tax. Depending on when the asset was first purchased, and this is going back years and years and years as to whether it's a pre-CGT asset, that'll deem as to whether you'll have to pay any capital gains tax. But once you sell it after 2 years, it is going to be a capital gains tax event. Absolutely. Whether you're in Australia as an ordinary Australian tax resident or a non-resident, the drawback of you being a non-resident selling it after 2 years is the fact that, one, no discounting of any capital gains, no applying that 50% CGT discount concession, as well as your tax rates on that capital gain are very high, minimum 32.5%, up to 37%, and then 45%. So it is a difficult decision to make whether you sell or buy. A lot of the time, some of my clients that have inherited properties that has been a main residence of a loved one, they end up just renting it out. And then usually around the 4 or 5 years sort of mark, that's when they might want to sell it and do something else. But in order to sell it and get further tax concessions, they need to be back in Australia as an Australian tax resident. So there is sort of the 2-year relief rule for non-residents, and after that's when it gets a bit tricky.
Exactly. And I think that's the thing. A lot of folks, yeah, the reason we do this podcast is just to make you aware. It doesn't mean you have to sell within 2 years. Just be mindful that if you do decide to sell, don't sell it in 2 years and 1 day, because the tax situation will be very different between before and after. So I think we covered off on that one really well with the main residence exemption. Let's kick on to the next one.
Well, I mean, smooth segue. We're on property, so let's talk about inheriting an investment property. And this is a scenario where typically you're inheriting a property which has never been a main residence, so we don't need to worry about the main residence exemption. Let's chuck that one out in the bin.
Yep.
If you're inheriting an investment property, and it's only ever been an investment property, things that you will benefit from, you'll take on the cost base of the original owner, and typically if it's a pre-CGT asset, so pre-CGT is going, but yeah, that's it. So if it's a pre-capital gains tax asset, you'll actually take on the cost base upon the day of death of that individual, and then anything you do to that property afterwards, that'll attract CGT. So if you're selling straight away, well, sometimes that can be a tax-free transaction. If you're inheriting a property, an investment property, and you're just going to keep it, then you do benefit from the 50% CGT discount concession up until the day that they technically owned it, and then it's passed over to you. But remember, as a non-resident, you don't get access to the 50% CGT discount concession for the period that you own it. Your income tax rate's obviously 32.5%, 37%, so on and so forth. What you're doing with that property thereafter, well, it's a tough decision. Sometimes you might just continue renting it out, or you might sell it. So if you're selling it, it does mean there will be tax to pay. Absolutely. Because again, you are a non-resident and you're taking on the capital gain or capital growth of that property. As I said before, you do get to discount a portion of the capital gain, and it all comes down to when you actually sell the property. If you're selling it pretty quickly and maybe within a year, that's good. You'll get a large chunk there, which will be discounted. But outside of that, you're not afforded many tax concessions because of your non-residency status.
Yeah, and I think that's the key thing, isn't it? It's almost reverse engineering what your intentions are with respect to that property. If it is going to be a core part of your portfolio, then by all means keep it. And as he said, just understanding the pre and post CGT implications from a pre-85, post-85 scenario, but then also to that scenario really around, okay, here's my liability, it's X. If I kick the can down the road, it's going to obviously increase, but this property doesn't form part of my grand plan from a financial perspective, and therefore maybe you are better off just biting the bullet now and being done with it and moving it on.
Yeah, absolutely. And I mean, typically obviously, when you're inheriting a property, difficult decision because it's not sort of the type of asset like shares that you can sell the next day and, the cash and proceeds are there.
Yep.
It's still a bit of a process. When you inherit the property, then naturally you've got to, find the right real estate agent to sell it. You've got the solicitor, all those sort of things, dealing with the wrap up of the estate. So just before you do anything and make a decision as to whether to sell, inform and educate yourself about the potential tax ramifications. That way you have a bit of an idea of what you're walking away with after all the tax is paid and it's come through the wash. Because if it's a case where that property in the past has also been used as a main residence and then it's been an investment property, it further muddies the water, doesn't it?
It does. Then you're looking at partial main residence considerations and all that sort of stuff as well too. So yeah, it's you do need to muck in when it's not the easiest time to muck in when you're grieving someone's loss. But yeah, certainly you need to make informed decisions, good, bad, or indifferent.
Yep, absolutely, mate. And I think that's a good probably point to move in and talk about CGT, event K3, sorry.
Yep. Yeah, no, exactly.
Yeah, and it's funny when you hear people say, "Oh, CGT K3, what's that?" And it's a lot of people have heard
or something, isn't it?
Yeah, it is. It is, and what's unique about CGT event K3 is it automatically happens if you are a non-resident beneficiary on certain type of assets. So it's a tough one for a non-resident to actually really account for because it's happened in the estate from a loved one, and then because they're a beneficiary of that estate, it automatically happens. It's not something that they can go back and really undo. The executor of the will, depending on how the will or estate plan is worded, can structure things so the proceeds of the estate are maybe a little bit more fair and equitable, if that makes sense. But CGT event K3, I mean, it happens automatically when you're a non-resident beneficiary. And I might throw it over to Brett to sort of give us a bit of an insight into what it actually applies to.
Yeah, so essentially it's any asset that's not land-based is the best way to describe it. So it's not classified as taxable Australian property. And as we know, taxable Australian property is essentially house, apartment, block of land. So it falls into one of three categories: collectibles, art, jewelry, antiques, personal use assets, cars, boats, furniture, electrical goods, and then others, which is shares, units in unit trusts, foreign exchange, and crypto. So, and managed funds, exactly. So essentially, Australian tax residents are assessed in Australia on ordinary and statutory income from all sources, whether inside or outside of Australia. But a foreign resident is only assessable on income from Australian sources. So Australian sources is, as we know, income, rent, and those sort of things. So what essentially happens with that K3 event is when you fall into one of those three categories in terms of the collectibles, the personal assets, or the other, is a lopsided scenario occurs. So let's say, for example, let's make it simple: brother and sister inheriting a testamentary trust, which is very popular these days. A lot of solicitors will do testamentary trusts because there are benefits from an Australian tax resident with respect to that scenario. Sometimes they don't take into account the situation from a non-resident's point of view. And the biggest problem that we see, certainly with the K3 event, is there is a triggering of capital gains tax. That means, in layman's terms, and I'm not going to go into too much detail on the call because people might yawn a bit, what it means is instead of getting 50-50, in terms of splitting the assets, it might be 50-30 because that person, that non-resident, is going to have a taxable event at the estate level. So when the net proceeds flow through to the beneficiary, that person as a non-resident will get a less result than the resident. Now, as we said before, you can structure your affairs in a way that, and it's not hard. It's just a matter of sitting down with your solicitor for 30 minutes and updating your will. And it's a tough conversation to have with your parents. Say, hey, when you die, can you give me this and not this? That's what it really boils down to. So essentially, you can obviously bring everything back to cash if that's the case, and then that money's split, happy days. If that you inherit the property and not the shares, then once again, a more equitable solution can be found. If your parents or uncle and aunt or whoever it is that's going to bequeath these assets to you is unaware of
Mm.
this. They may think they've got your best interests at heart, which most people in Australia do think that. They don't understand how things get different when you move overseas.
Mm.
So really just going back and look at the underlying assets and how they're divided can make, a difference of a third to your inheritance, which
Yeah.
I think everyone would be entitled to, feel like they've been ripped off if the brother's getting this and the sister's getting this, when in actual fact it should have been 50-50 to start with.
Yep, absolutely. And I mean, it is a very difficult conversation to be having. I mean, talking with your elderly parents, which might already be in care or they're moving that way. I mean, when you talk about sort of, health directives, end of life, those sort of things,
Yep.
an estate plan, and I mean, to our listeners, a good will and estate plan, you need to really look at it at a bit of a framework and roadmap of how things get dealt with in the event they pass away. It's a tool. It's a really good, effective tool when they're done correctly that removes the need for you to make hard decisions upon their passing because the decision's already made.
Yep.
So, and it's not something we probably harp on too much about because it can be a bit of a morbid topic. But, if you've got elderly parents back home and, you're obviously going back for a trip back to Australia or catching up with them on the Zoom, it is a conversation point that you should bring up and just say, hey, when was the last time you actually looked at your will? Have you established a power of attorneys? We just want to make sure that's all tied off and there's no loose ends. Because again, it is a framework to obviously help you deal with making difficult decisions because the decision's already made. The executor is just following it to a T, and that's it.
It's the voice from the grave, isn't it? And just so folks get a better concept of it, what I'll do is I'll put it in the link in the description below to a blog article, a big one we did last year on how to manage it, what the implications are and those sort of things, because a K3 event can be complicated. It's very hard to articulate on a podcast exactly how it works. But I think, people can see essentially it depends on the assets, the classification of the asset and how that's divided. But down below, there'll be a blog article that goes into quite a lot of detail with case studies and those sort of things.
That's it. And I mean, the last one I wanted to just touch on today was superannuation. Most Aussies overseas, they've got super, they don't attend to it too much, or they're sort of trying to shoehorn everything into it as part of their retirement planning in the next, say, 5 to 10 years. But binding death benefit nominations. So what a binding death benefit nomination is establishing a beneficiary on your superannuation account in the event you pass away. So often it might be a case that this is going to be maybe a spouse, a child, potentially a legal representative, which is usually the executor of your will. And there's many different ways that you can sort of nominate. You can do a non-lapsing one. You can do a lapsing one, which typically is every 2 to 3 years, which lapses, and then you've got to establish a new one, or a non-lapsing one, which is fixed and it doesn't get replaced until you establish a new non-lapsing one. But what we often have come across in the past is, even on just general industry super funds or retail super funds, is that the individuals that have been nominated aren't actually valid because someone has actually just nominated their mate or a cousin or someone that's not technically a tax dependent.
Or brother or sister.
That's it. Absolutely. So when you nominate, you need to make sure you're sort of falling within the typical definitions, especially the tax definitions. Because if you're nominating a cousin, sister, a mate, the super fund won't actually pay those funds to that individual because that's technically not a valid beneficiary or a nomination, which means the next sort of protocol is, okay, well, is there a will that might have a letter of wishes within it that governs what's going to happen to superannuation? If not, then super goes into this fun little thing, which is called intestacy. And it's a case where you essentially need to get a death certificate and go through the process of dealing with the state of that asset. It's ridiculous, but unfortunately that's the way the legislation is written. So if you do have a binding death benefit nomination, or you're unsure as to whether you actually have a beneficiary on your super accounts, you need to go back and double check because it is a formal legal document. And often a lot of the ones that are made on super funds are actually incorrect. And obviously that means that there's not too much there to govern what happens to that big asset. Typically an option is nominating a legal representative 100%, which means that you've done a will or an estate plan, which dictates what's going to happen to those superannuation monies. So you might just say, yep, 100% to a legal representative. And then within your will, it just says that your super is part of the sort of the proceeds of your estate and then gets obviously carved up to the different individuals as part of your beneficiaries. So it's a really important one because too often we have come across a lot of binding death benefit nominations on old super fund accounts or new clients coming on board, and they've actually nominated someone which they thought was the right thing to do, which it is, but it's not actually sort of correct or valid under the typical tax definitions.
Yeah, I mean, the best way to describe it in non-tax, non-legal speakers, they can only be a husband, wife, spouse, someone who's a direct, family member, and
Mhm.
or a child who's financially dependent. That's it.
That's
If,
it.
if, if
Yep.
people aren't on that list, then they've got no chance of being paid out. Also,
That's
too,
exactly right.
I'll add to the list is what we call a non-binding nomination. And I've seen lots of these ones. And essentially a non-binding one is your wish to the trustee of the super fund that this happens, but it doesn't mean the trustee is legally bound to follow your wishes if they find a better alternative.
Yep.
So it's like a IOU, if you're thinking like that, yeah, please can you, when I die, do this? But
Yep.
it's up to the trustee, whereas a binding, the trustee is bound. As long as the
Yes.
nomination is valid,
Valid.
the trustee is bound to make that nomination.
Yep, absolutely. And I mean, we could go a step further if we wanted to. And I mean, right now we're talking about super accounts. If you had an account-based pension going, you can nominate a reversionary, which essentially means that your income stream will get paid to your reversionary nomination. And it still needs to be under sort of that, I suppose, categories
Partner,
of different
spouse.
types of peoples. That's it.
Yeah.
There'll be some tax rules which apply there, depending on how old they are, the reversionary beneficiary. But it's a really important takeaway to go back and check if you actually have one. If you don't, nominate one. If you can't nominate one within that category of different people, then it means it would have to go to your will. And then if you don't have a will, then it might be time to get a simple will established, just so you're tying off that loose end.
Yeah, I think you're spot on, and that's what we see. And there are pros and cons in terms of reversionary pensions. Certainly one benefit is the cash flow stays the same, continues
That's
on.
it.
Downside is if they go, you lose the whole balance. So there's
Yeah.
no re-inheritance of that entitlement. If Frank is 80 and he passes away and his wife Maisie comes along and becomes the reversionary beneficiary, and then she dies a year later, then regardless of the balance, it's gone.
That's it. And you can't really, well, you can't actually turn a reversionary into your own estate.
That's right.
And once an income stream is set up, as you said before, through a reversionary pension, you can't change that. You can't go back to the super and go, hey, I want to actually pay out this as a lump sum.
Yeah.
The trustee's bound by law just to keep it as is.
Yep. Exactly. They're just following your wishes. So, mate, I think it's a good summary. I think
Yeah.
we've covered off the inheritance side very well. Obviously, links down below to both the Facebook group, um, blog articles regarding K3 events and also inheriting property, both main residence and investment properties. As always, give us some review, guys. We give everyone a bit of time every week to put this together. So all we ask for in return is just to fill the love with some reviews and some ratings. Helps us get the message out there. And I think we call it quits for the week and kick on again next week.
Sounds good. Thanks, guys, for tuning in today. And in the meantime, Brett, I'll catch you on the next episode.
Cheers. Thanks, mate.